If you're not curious, if you are someone who wants consistency and do the same job over and over each day, the venture capital is not the place, and probably being a startup founder is not the place. And frankly, I think that's the beauty of this business. It's just fun because every day is a little different, right?
Welcome back, everyone, to VC Unfiltered. We're incredibly excited today to welcome back Derek Norton from Watertower Ventures. Derek has been a staple of the LA ecosystem for years now, and we're so incredibly excited to be able to talk to him today. Derek, welcome to the show.
Yeah, it's great to be here. Thank you for having me.
No, it's always a pleasure to be able to catch up with you. So I want to find out, and especially for the viewers on the that are watching, I want to first just kind of get a high-level overview of Watertower, what you guys are looking at, what you're excited about, and then we'll dive into some of the more fun topics out there.
We've always had a view. We've always wanted to be the first institutional capital into a company. So at the time that we're writing the first check into a business, I mean, we might be writing that check along with mom and dad, we like to say, right? It's really early. So typically at the, could be as early as the ideation phase where we're just getting behind a couple of founders who maybe we've known for some time or really, really believe in the vision of what they're doing and their ability to build something special there. In some cases, they've got product. So it's kind of everything in between that of just ideation to product, usually not a lot of revenue. Although I would say there's a bit of a market dynamic change right now that we're seeing companies that just for whatever reason the founders didn't go out to market, I think because the conditions were so challenging in 22 and 23. So they've bootstrapped the business, and it's very refreshing to have people walk in with $1 million of really solid ARR revenue, and they haven't raised any money. So we're starting to see kind of what I think is the output from very challenging times that really tested the mental of the founders that were starting businesses back in what was a very, very challenging financial environment. We always like to be that first institutional check, and we're typically the lead investor and or the co-lead, but happy to also just be a part of a syndicate if they've already got their lead and co-lead put together. And the majority, we're typically writing about $1 million check and think single-digit valuations is that entry point. So pretty easy math. We're going to own about 10% of the company after that initial investment, but lots of flexibility around there. And so we like to call it flexible capital.
Honestly, I agree with you, especially over the 22 and 23. I feel like the founders are a little bit more battle hardened that have come out, especially in 24 and what we're kind of seeing where money was way too free flowing kind of in 20 and 21, and the stuff that ends up coming out, especially in more hard economic times, are probably more akin to what we kind of saw in 2008, 2009. So yeah, 100% agree with you on that kind of stance. Any fun investments that you've seen over the last 6 months that you're kind of super excited about or super bullish on?
We're finishing up investing out of a 21 fund. So probably should have been done in what you call typical market conditions. We would have invested that capital in about 3 years. It's going to take us 4. So as a consequence, and again, as I referenced those market conditions of 22 and 23, we're now seeing the first set of our portfolio companies, go out and raise a late seed or raise their Series A and get those first set of markups, outside validation from Series A investors. So we're really, really excited about that. I think every business, at least our perspective, has some attribute of they're building and utilizing technologies around AI. And they've been building, through large language models or whatever it might have been. So seeing kind of the output of how that's changing and affecting the way that they're building their company, the way that they're building their product and all of that, I think we're all really excited about that and the efficiencies and the scale that can be achieved.
No, it's awesome. So is that the typical space that you're looking at, AI, or what kind of sectors are you normally looking at?
It's funny, right? We kind of refer to this technology enhancement, I guess I'll call it, of AI, of blockchain as the third wave. So if we think to the first wave, really, let's call it mid to late 90s, early 2000 of a protocol, HTTP, .com. And again, every business, every company, everyone's lives change as a result of that. And I think we can draw a similar sort of analogy there to mobile. And so think like 08, 09, again, every business became a mobile first business. And so you had, we're a .com, we're an internet company. we're a mobile first business, we're an AI, we're a blockchain company. I think they're just going to be a company that's utilizing technology. And I think that's what the prior two waves have turned into. We think the third wave will turn into something similar. But again, really exciting about what you can achieve and accomplish with these technologies. And we kind of think that blockchain needs AI and AI needs blockchain in a way. And so we think a lot about some of the challenges that both of those technologies bring and together the solutions. So a lot around trust. Our new fund, which will be Event 25, a lot of that thesis is around trust, right? And so looking at people building businesses that can eliminate, let's call it some of the things that could happen, nefarious actors around things that are generated through artificial intelligence. And, I think it's very similar to cybersecurity, right? It's a problem that always exists. It's never going to get fixed, but you're going to continue to build technologies to hopefully avoid being breached. Same thing with AI. You're going to be looking at what are those bad actors, bad characters out there? Where are the opportunities for efficiencies? And we're looking for businesses around that.
That's a super interesting thesis. I'm always curious how other investors kind of come up with their thesis. Like, how did you end up landing on that? Was it just personal experience of what you've kind of seen in the market the last couple of years, or how did you specifically kind of land on that?
Well, I think maybe I'll step back for a second. I think, it's important to know, I think, to try and simplify where we spend our time looking for investment opportunities and looking for exceptional founders who are building these types of products that are going to be daily, repetitive, and mission critical in their use. So I'd call it, kind of half of our effort and time is spent in the enterprise. So looking for very verticalized solutions inside of that in specific areas, financial services, fintech, and specifically what we call capital markets infrastructure. So think of these things, it could be a proprietary solution to the private credit market, for example. It could be something in and around legal and how someone's working on that as it relates to the financial industry. So we have a lot of our effort and time is spent there. Things that are going to improve the way that workplace automation is handled. And so, again, spending a lot of time focused there. We've got some deep expertise in and around prop tech, real estate tech. Challenging space right now and has been, but we think there's some very unique opportunities that are going to come as a result of the past couple of years and as we shift into hopefully a better economy and a lower interest rate environment going forward on that. Second kind of area of focus for us, I'll call it the other effort that we put forth, is in and around really consumer technology. So think B2B to C technologies, where you're really selling into a large provider who has a large consumer audience out there. We do a lot in the media space. So we're one of the few firms, I think, that has a desire to focus on media. That could be gaming companies, it could be music technologies, it could be anything in and around kind of commerce infrastructure that might be using content to facilitate a transaction. So you see a lot of that. You could put it into the influencer category. We like to say people who have large audiences and have agency and influence over people's decisions. So commerce infrastructure is another area that we focus on. We don't do anything in the healthcare space. We're all intrigued by it, but just don't have a deep enough network of relationships or experiences there to sort of do that. We don't do anything in the pharma space, bio space, anything like that. We're probably not investing in a company going to Mars. So think of these as kind of just core, practical, mission-critical businesses that are there. And again, I like to say, we're looking for these businesses. What we're really looking for is the founders, right? We're in the people business at this stage, and we're getting behind a founder. So hopefully that gives you a little bit of clarity into what we look for and strive to invest in. I call us broadly focused.
It's a good term. Are the reasons that you chose that area is because of domain expertise within the firm, or is it places that you find interesting that you see maybe a competitive advantage that you guys have in the market, or what kind of led you down the road?
It's yes and yes. We don't invest in anything where we don't have some experience and where we can't bring a deep network of relationships. I think at the end of the day, the best thing that you can do and the most, if you want to call it that value add, the most value you can contribute to a company as you go through the business building process is introducing them to potential customers. So if we can't do that, if we don't have that network of decision makers there that can really change the trajectory of a business that we've invested in to be those first set of proof of concept customers, design partners, and eventually paying customers, then I'm not sure you have a lot of business and agency investing in those types of businesses. I think the second thing too, a lot of our LPs come from those areas that I've just described. So a lot in the financial side. My partner Jeremy Milken, he and his family have a deep network of relationships throughout the financial world. And we can apply those and deliver those relationships to our portfolio companies. Same thing in the media sector. We have a number of limited partners. You can see on our website 2 members on our LPAC who are very high-profile media executives in that regard. So again, very, very helpful to a company that may want to look for a partnership, potential for, just a paying customer in that area. And then I'd say the other thing that we do and get very involved with our portfolio companies is when they first get ready to start looking for outside capital, right? And so, because we typically are investing from the pre-seed through the seed, that can entail us underwriting that investment with 2 investments, 3 investments, potentially even 4 checks that we write into that company. But by the time we're at the Series A and certainly at the Series B, we probably are fully allocated into that position. And we get very involved with those companies in helping them raise outside capital. And, I spent many, many years as a venture banker doing that. So that network of relationships has really benefited them. Our prior fund had 24 portfolio companies. We've had 36 markups in that fund from outside capital. So a lot of that's just us rolling up the sleeves and getting involved and helping founders build decks. And most importantly, I think, making the introductions. Fundraising is a massive distraction. And we want to eliminate that distraction from our founders and keep them focused on what they're supposed to be doing, right? Which is building product, building the business.
So how do you balance that as someone that's managing the portfolio? As a manager or steward of capital, you're pulled in 1,000 different directions constantly, right? So if you have 50 portfolio companies, like how are you managing that, the different needs from each one, and then same with being able to balance with the LPs on what they're asking for?
Yeah, I think it's not that dissimilar to the CEOs that we invest in, right? And the teams that we back, right? And you just have to be ruthless with your time and allocate it accordingly. And again, I think you can do that when you have networks of relationship and where you have domain expertise, you know how to utilize it, and the impact can be measurable as a result of that, right? So you're doing maybe 2 or 3 things as opposed to 10 things, but those 2 or 3 are incredibly impactful to the company. So again, and I think we as a team, we as individuals who have built multiple businesses, between the partners here at the firm, we built 11 companies between us. You sort of understand how to delegate. You start to understand how to focus. And, for myself, I try to get one very meaningful thing accomplished every day and a couple of subtasks underneath that taken care of. And a lot of that has to do with making an introduction, helping someone think through something. Very, very subjective, objectable, types of deliverables.
You've built 11 businesses. You have raised and helped raise capital for a bunch of different companies. Walk me through some of either the best practices or some of the things that you've seen that you've been like, ooh, that's not great. Let's not do that again.
Yeah, well, I think not having money in the bank the night before payroll is one. Let's not do that again.
Yeah,
right? And I unfortunately did that a couple of times in the first couple of businesses that I was building. No, I think and you say this, you sympathize with it, you understand the sort of the journey that you embark on when you're building a business. We joke around here, but we're not really joking. Every 3 years we're building a new business, right? We have a set of investors that are now investing in us yet again to have us go out and prove ourselves yet again. And, you have to do that. So, we always have our startup hat on. We're never not a startup around here. And so from that perspective, we sympathize with the people that we invest in and understand it's not, to use the term, it's never a straight line, right? It's all over the place. We have a portfolio company. I think they pivoted, like a kind of a legit, tried things 4 or 5 different times and finally locked in on something. And, I think most really successful companies will tell you there was some directional shift that occurred within the building of that business that took them from their original idea to where their actual business is today and the success that they're having there. in all of it. So yeah, I think you wake up, if you're not curious, if you are someone who wants consistency and do the same job over and over each day, that venture capital is not the place, and probably being a startup founder is not the place. And frankly, I think that's the beauty of this business. It's just fun because every day is a little different, right? And you get thrown a loop, and sometimes you get thrown a pleasant surprise, and then you get thrown the unpleasant surprise, and you got to roll with it. And I've learned from a lot of incredible GPs out there who I saw them hang a shingle 15, 16 years ago and build firms like First Round and First Mark and Spark and Union Square and Graycroft and a host of others. So I've been fortunate to kind of take a couple of pages from their playbook, get some great mentorship, some great advice, and be a part of this great industry.
That's super interesting. And honestly, from that standpoint, because we do have a lot of emerging managers that do end up watching the program, that or even angel investors that are considering eventually creating their own firms, what would be a piece of advice that you might give them if they're looking at that space and are starting on that actual journey?
Well, I think you're building an investment firm, right? I think this idea, hey, invest in my fund or partner with me as I build this investment firm in this early stage venture asset class. In doing that, and I think I've watched the game of venture capital get played a couple of times now, and then you kind of run up and then run down, and we witnessed that at the end of 20 and throughout 21. And I think it's nice now we're back to the business of venture capital and understanding that this is, you don't just sink money into a company and they all turn out successful and you make a lot of money. It's a lot of work. It's a very long process. You get in business somebody at the stage that we invest in, and you're probably looking at a minimum of 7-year relationship, and it's probably more likely a 10-year relationship, and hopefully it's a 15 and a 20-year relationship where you've been involved in a number of things they've done, or you've watched something that they originally built and it went on for a very long time.
100% agree. I am curious because you had mentioned that you, since you invest in pre-seed and seed, and you've helped from a fundraising standpoint for Series A and Series B. Just out of curiosity, which round do you think is probably the toughest jump to make? I've always kind of felt that seed to A was a very difficult one in general, not probably as hard as pre-seed to seed. But I would love to get your kind of take on that just in general, since you've seen the whole spectrum.
I think the A is actually the easy round to get to,
Wow.
And I've heard a lot of fellow VCs, say, and we say it here too, the A is not the win, right? That's just kind of a next step in the process of getting there. You've got some early revenue, which is frankly not that difficult to generate, to a couple million, call it 2, call it 3, call it 4. I don't think it's 1 anymore, thankfully. But you're showing that there's actual business there, and at that point you've got some sort of sales funnel that you can put some realistic weights on to see what that's going to convert in the next couple of years and how you're going to utilize that capital from that Series A. I think that jump when you become a $20 million company, that how do I now become a 50? I remember someone saying to me when I was first building my first companies, getting to the 5 was one thing. It was getting to the 10 and then to the 50. And that's when everything changed, right? And that's where you changed as a manager. You were either meant to take it to 100 or not. And so I think that becomes challenging. I think the capital stack, as we call it, the private capital stack, has completely changed. We've never seen this much capital in the system. I can name a bunch of what they would call themselves as Series A funds that used to be 4, 6, maybe $800 million funds. They're now 4, 6, and $8 billion funds, and still writing checks into the A. So I'm not sure how you cycle that capital through. I think it's going to change dramatically. So I think the A is going to could become a very crowded, very kind of commoditized space, commoditized from the standpoint of these large asset gatherers really competing on price and not on value and nothing else. And I think it almost becomes just kind of like a scout check for them at that point. It's a rounding error, and they're going to see if it works, and if it doesn't work, it's fine. And if it works, they've got some pro rata right into the B and potentially into the C and beyond that. So we've got a very different market, I think, that's happening. Again, I think, we're back to the business. How do you think about capitalizing these companies? One of my colleagues, Idan Levy, wrote a very thoughtful piece. You can find it on our website, called The Mechanics of Capitalization. Kind of lays out and illustrates our view on how we think about capitalizing a very early stage business, and what's going to provide the right capital structure to the founders, but also lessen the dilution that they're going to take if they kind of go too quickly and jump up to that A and jump up to the B really quick. So we just think there's a way to systematically build and capitalize these companies the right way.
I think it's super interesting, and honestly, I'm definitely going to check out that article because I love nerding out on the math of power law and how we're looking at these things. And when you start getting into the $4, $6, $8 billion companies, especially that are trying to deploy capital, it becomes there's only so many successful startups, and there's only so many startups in the ecosystem, and so that the constraint becomes odd to me that I'm not sure how you start how the math ends up working towards something like that for the returns that are necessary and what you end up needing. So
I'm not sure it does.
Yeah.
I mean, I think we've been witnessing this for a while, and the capital scales, it becomes a commodity, and so that scale is great. But what doesn't scale and was not a commodity is very special founders who are building transformative businesses, and that has stayed pretty consistent and has not commoditized. And we call it, when these market shifts occur and you kind of go back to the game of venture capital, what you end up seeing in those markets are what we call these very market driven founders, right? And they're in the business because it's the metaverse, or because it's crypto, or because it's AI, or because it's whatever flavor is there. It was .com because it then was mobile, right? As opposed to, I think, what we've witnessed the past couple of years, and why you're now seeing businesses that have $2, $3, $4 million of ARR and they've never raised a penny. They bootstrap the companies, is these very mission-driven founders, these very special founders building these businesses that are going to be incredibly important and strategic to the customers they're selling to. And we've thought about our capital that way. We think about, this as being a product that we've been building at Watertower Ventures for our customer, who happens to be that founder building that transformative business.
Let's end it with this. I don't know if you have a specific hot take that you have that you would love to give us. It could be controversial. It could not be. Totally up to you. We've had some great ones that have come through. But if you have something that you would love to share that you maybe is on the edge, this is now the time to be able to share that.
Yeah, you want me to overshare? Is that what it is?
Oh God, I would love so.
Well, I maybe kind of dovetailing off what we just talked about in this is, I think you're going to start to see, because of the amount of what we'll call earlier stage, very institutional, very tier one venture brands out there who now have $4, $5, $6, $7+ billion of capital to deploy. You're going to start seeing these Series A's where multiple firms are competing for the opportunity to back that company. We're going to see these $200 million valuations. We talked to one firm. Their most recent fund is just north of $5 billion. And the partners in the firm have authorization to write a term sheet up to a $300 million valuation to win the deal in anything kind of AI related at the Series A. I think we were all a little shocked, in 21 and 20 when we started seeing these $100 million Series A valuations.
With 300 of A?
Yeah. And so I think 200 might become just kind of the new, when you see these competitive situations come about, that we start to see that as the number. We will see. There's my hot take. Where I'm thinking that we're going to see this market, and at that point, it changes the dynamics pretty greatly in terms of how you start to think about, how do we carry the cost on that, how do we mark to market versus what it might look like. But I also think we're going to see a lot more these businesses, because of the impact that new technologies are going to have on that. Much more efficient to build, fewer employees to build that business, quick scale inside of their customer base that's there. So the idea that within 24 months you could see $5 million of really good revenue, and seeing that double, maybe it's even tripling over time. Of course, with those kind of, that amount of capital to deploy, it's going to get incredibly competitive. and they're going to compete with one thing, and that's going to be valuation.
100% agree. So honestly, great hot take. And Derek, thank you so much for coming on the show. It's always a pleasure to speak to you and have a great conversation. So thank you again.
Super fun, Lucas. Thanks for having me.